During World War II, the United States military had a problem. Their bombers were getting shot down at an alarming rate. So they studied the planes that made it back, carefully mapping every bullet hole on the fuselage. The pattern was clear: wings and body riddled with holes. The conclusion seemed obvious: reinforce the areas taking the most damage. Then a statistician named Abraham Wald said something that changed everything. No, you need to reinforce the areas with no bullet holes. The military was confused. Why armor the parts that weren't getting hit? Wald's logic was devastating in its simplicity. You're only looking at the planes that came back. The planes that were hit in the engine or the cockpit, they never returned. The bullet holes you see are the ones the aircraft survived. The missing holes, in the engine, the fuel system, the cockpit, those are the ones that were fatal. The military was about to make a catastrophic decision because they could only see the survivors. This is survivorship bias, and investors fall into this trap every single day. At the end of last episode, I mentioned the 2020 EV revolution. Everyone remembers Tesla, but how many remember the companies that didn't survive? That's what this episode is about: the graves you never visit, and why ignoring them distorts everything you think you know about investing. Survivorship bias has a simple three-step structure, and once you see it, you'll notice it everywhere. Step 1. Successes are visible. The winners get media coverage, social media buzz, and a permanent spot in our memory. Tesla is on every financial news channel. Warren Buffett is in every investing book. Step 2. Failures disappear. Companies go bankrupt and get delisted. Their ticker symbols vanish from stock screeners. Their charts stop updating. Funds that perform poorly get quietly liquidated or merged into better performing ones. Failed entrepreneurs don't write bestsellers. Step 3. You look at what's left and conclude that success is normal. Since the only things you can see are the survivors, the world looks far more successful than it actually is. This is especially dangerous in investing because the financial system actively erases its failures. Delisted stocks disappear from charts. Liquidated funds vanish from rankings. Bankrupt companies fade from headlines. What remains looks like a world where stocks mostly go up and smart money mostly wins. If you watched episode 1, you'll remember Bessembender's study of 26,000 stocks over nearly a century. 57% of them, more than half, failed to beat a simple treasury bill. The entire net wealth creation of the U.S. stock market came from just 4% of stocks. But when someone says, stocks always go up in the long run, which stocks come to mind? Apple, Amazon, Tesla, the survivors, not the 14,000 that trailed government bonds. Let's look at 3 cases where survivorship bias warps investors' judgment. Case 1. The 2020 EV revolution. Tesla and the 4 graves. Cast your mind back to 2020. Electric vehicles were going to change the world. The narrative was everywhere. EVs are the future. Get in now or miss the boat. 5 companies were constantly mentioned as the EV plays to own: Tesla, Lordstown Motors, Nikola, Workhorse, Arcimoto. Here's what happened. Tesla went from about $28 split-adjusted to around $390 by early 2026. A 14 times return. An incredible investment. Lordstown Motors went public through a SPAC, promised an electric pickup truck, and filed for Chapter 11 bankruptcy in 2023. Total loss. Nikola hit a peak of $93 per share on promises of hydrogen trucks. Its founder was convicted of fraud. The company filed for Chapter 11 bankruptcy in 2025, down over 99%, effectively a total loss. Workhorse went through 2 reverse stock splits and trades at around $3 today on a split-adjusted basis, down over 99% from its peak. And Arcimoto, the maker of 3-wheeled electric vehicles, was delisted from NASDAQ after halting production. It now trades on OTC markets for pennies, another near total loss. 5 EV stocks, 4 graves, 1 survivor. When someone says, "I should have bought EV stocks in 2020, they're only talking about 1 out of 5. If you had spread your money equally across all 5, the 4 catastrophic losses would have wiped out most of Tesla's gains. The narrative of the EV revolution was correct. Electric vehicles did become the future. But picking the winner from a field of 5 was the hard part, and 4 out of 5 investors who bought the hype got destroyed. Case 2. The mutual fund graveyard. Have you ever seen a headline like, "Top 10 Best Performing Funds of the Decade"? There's a hidden trap in those rankings. The SPIVA scorecard, one of the most rigorous studies of fund performance, reports that over the past 20 years, roughly 64% of U.S. equity mutual funds have been either liquidated or merged into other funds. Gone, erased from the record. And here's the key. Those disappeared funds were overwhelmingly the poor performers. Fund companies don't shut down their winners. They shut down the embarrassments, the ones dragging down their marketing numbers. So when you look at the surviving funds and see that, say, 40% beat the index, that number is inflated. It only includes the survivors. SPIVA corrects for this by tracking all funds from the starting point, including the ones that died along the way. The result? Only about 10% of active funds beat the S&P 500 over 15 years. The difference between 40% and 10%, that gap is pure survivorship bias. The graveyard of dead funds is invisible unless you deliberately go looking for it. Case 3. The success story illusion. Here's a formula you'll find in almost every business book and investing seminar. Study successful people. Find their common traits. Teach others to replicate those traits. What do successful investors and entrepreneurs have in common? Concentrated bets, deep conviction, a willingness to take big risks. So the advice becomes, concentrate your portfolio, have conviction, embrace risk. The problem is devastating once you see it. Failed investors and failed entrepreneurs had exactly the same traits. They also made concentrated bets and lost everything. They also had deep conviction in the wrong thesis. They also took big risks, and the risks didn't pay off. The difference between a visionary and a gambler is often just the outcome. But we only hear from the visionaries. The gamblers don't give TED Talks. They don't write books. They don't get profiled in magazines. They just quietly disappear, like the bullet holes that Wald said to look for. The correct approach is not to study what winners have in common. It's to study what separates winners from losers, and that requires finding the losers first. So how do you protect yourself? Before making any investment decision, run it through 3 antidote questions. Question 1. Where are the graves? Whatever investment thesis excites you, ask, what are the companies that followed the same thesis and failed? If you're excited about AI stocks, don't just look at NVIDIA. Find the AI companies that have already stumbled. C3 AI, Big Bear AI. If it's the metaverse, remember the companies that pivoted to the metaverse and went nowhere. For every survivor you admire, there's a graveyard you're ignoring. Go visit it. Question 2. What's missing from this data? Whenever you see a ranking, a backtest, or a performance chart, ask what has been removed. Does that fund ranking include the funds that were liquidated? Does that stock backtest include companies that were delisted? Does that index return account for the stocks that were kicked out and replaced by better performers? If the answer is no, or if you don't know, the numbers are flattering the survivors. Question 3. Have I actively searched for counterexamples? Survivorship bias and confirmation bias are partners in crime. Survivorship bias removes the failures from your field of vision. Confirmation bias makes you stop looking once you find evidence that supports what you already believe. Together, they create an airtight illusion. The antidote is active disconfirmation. Before you commit to any investment, force yourself to find at least 3 specific examples of similar investments that failed. If you can't find 3, you're not looking hard enough, and you're probably not seeing the full picture. Here's what you need to remember from today. Rule 1. For every Tesla, there are 4 graves. In the 2020 EV hype, 4 out of 5 companies went to zero or near zero. The survivor gets all the attention. The dead get forgotten. Rule 2. 64% of mutual funds disappear. The ones that survive look better than reality because the failures have been erased from the scoreboard. Rule 3. Success stories are selected, not representative. Winners and losers often did the exact same things. You only hear from the winners because the losers don't write books. Rule 4. Always ask, what am I not seeing? The most important data in any investment decision might be the data that's missing. Delisted stocks, liquidated funds, failed companies, they vanish from view, but they should never vanish from your analysis. Abraham Wald looked at bombers and saw what wasn't there. That's your job as an investor. Don't just study the survivors, hunt for the graves. Now, over these last 2 episodes, we've learned to check the base rate and filter for survivorship bias. But there's one more foundational trap that affects every calculation you make about risk. The assumption buried in every finance textbook, that stock returns follow a normal distribution, a neat bell curve. In March 2020, 8 consecutive trading days moved more than 4 standard deviations. Under a normal distribution, even one of those days should happen only once every 63 years. 8 in a row? That shouldn't happen in the lifetime of the universe. Next episode, Fat Tails, why the bell curve is a dangerous lie, and what it means for your portfolio. Thanks for watching. If you found this useful, subscribe and hit the bell so you don't miss the next one. See you in the next episode.